This is Adam from the Winnipeg Financial Planning Team, and welcome to the third part of my 5-part tax series. If you haven't had a chance to watch the first 2 videos, I recommend you do so now. Today I'm going to present to you one of the tax planning opportunities that may be available to players, and I'm going to provide a simple example of the decision that can be made of whether or not to cease Canadian residency for tax purposes and file taxes as a U.S. resident. So in this example, we're going to imagine a Canadian-born player living in Winnipeg, Manitoba, who is now playing in Tampa Bay, Florida for the Tampa Bay Lightning. And we're going to assume that they're earning $5 million as their annual salary and that they spend time in both Canada and the United States. We're going to look at the difference of the after-tax income that a player can earn based on the tax rates in those 2 places. So, assuming they're earning $5 million, we're going to assume that they are in the highest marginal tax bracket in both of those jurisdictions. If we start with Winnipeg, in Winnipeg, you pay tax both provincially and federally. So the provincial tax rate for the highest tax bracket is 17.4%. And the highest tax rate federally is 33%. So your all-in tax rate, if you're in that highest tax bracket, is 50.4%. So at the end of the year, if you've made $5 million after taxes, to keep things simple, you'd have $2.25 million. Now, in Tampa, if you filed taxes as a Tampa Bay resident, the state tax in Tampa Bay is 0. You pay no income tax in Florida from the state's perspective. Federally, you'd be in the highest tax bracket federally in the United States, which is 37%. So all in, your tax rate is 37%. So at the end of the year, after paying your taxes, your net income, again, keeping things simple, is $3.15 million. So you can see on the surface the difference between paying taxes in Winnipeg and the difference between paying taxes in Tampa Bay. So this decision can become a relatively huge decision for players. And it may make sense for them to cease residency as a taxpayer in Canada, pay taxes in the United States, because the savings, as you can see, each year could be paramount. But now there's clearly, and obviously, a lot of things that need to be considered here. First and foremost, do you pass the substantial presence test? And can you actually file as a U.S. resident? There's rules and tiebreaker rules that come into effect, but essentially, are you spending enough time? Are you actually a resident of the United States? Because if you're not, you're going to have to pay taxes as a Canadian citizen and a Canadian resident. The second thing is, do you have any large assets in Canada? Because when you make that decision to cease residency, you may have a large tax liability because all of your assets will be deemed disposed of when you make that decision. So in summary, what you need to do to see if this is an option for you is discuss this with a cross-border tax professional. They'll be able to tell you the answers to those 2 questions that I just told you there, and they'll also be able to tell you the ins and outs about if you make this decision now, what happens if you get traded back to Canada and you want to become a Canadian resident once again in the future. Is that a hard thing to do? Is it easy? They'll be able to help you out with that. My responsibility in all this is to put you in contact with one of those cross-border tax professionals to help facilitate that conversation and help you get ready for tax time. I hope this video has been informational for you, and in my next video I'm going to discuss something called an RCA trust, which is an opportunity in Canada for Canadian taxpayers and pro hockey players in Canada to maybe shelter some of that income to make up that difference between how much tax you pay in Canada compared to some of these states that have no income tax. Thanks for watching.